weekly multifamily. No, really?
Oh,
No, dang it.
I know.
Scrap it all.
Jeez.
Everybody go home, pack it in.
That was a really good start.
I was ready. I was so psyched. After our podcast the other day with Ruben Greth, I was like practicing my ringside announcer voice because he got me really inspired. So I was trying to bring the heat.
Damn.
All right. We are live and ready to go.
All right. Welcome to the Weekly Multifamily Roundtable, where each week we three amigos, Anthony, Dan, and Rodney, get together to try and learn something new about multifamily investing. Whether you're new to apartment investing or old and crusty like us, if you're looking to take your real estate career to the next level, then you're in the right place. So come join us as this week we set off to learn more about current market trends, COVID, and maybe, just maybe, have a little fun along the way as well. If you're opposed to fun and learning, then you best get on out of here now, because the Weekly Multifamily Roundtable is leaving the station. Toot toot, all aboard. And I'm out.
Well, welcome to this week's Multifamily Roundtable, and thank you for that introduction. This week's guest is Parker Webb from Kansas City with FTW Investments, and we're going to talk this week about the market trends for COVID-19 and beyond. And so, Parker, if you could take a few minutes and just tell us about yourself and give us a little history and how you got started, and then we'll take it off from there.
Absolutely. So, Parker Webb, one of the co-founders, kind of managing partner, and CEO of FTW Investments. We specialize in acquiring principally multifamily, but also some commercial assets as well. And I'm born and bred here in Kansas City love.
Showing the love.
Charlie,
Nice.
I love it when people have like home city pride. It just warms my soul. I like it.
Absolutely. I'm also hoping for a sponsorship from Chase over at Charlie Hustle. So
okay. Or sponsorship from the city itself. Can cities sponsor people? Like, that'd be pretty cool.
They sponsor our deals sometimes. So
there you go. Perfect.
But no, we got started in really the multifamily syndication business a few years ago. I started in investment sales, mostly selling shopping centers, and kind of parlayed that working with some groups, buying shopping centers, and really kind of found that I wanted to stay close to home and do deals in Kansas City and focus on Kansas City, which is really where we have more expertise. And a mentor once told me, the further I get from Kansas City, the dumber I get in real estate. So I learned that lesson and trying to stay close to home.
That's brilliant advice. It's one of the reasons Dan and I, we stay in Minneapolis, we in the Twin Cities in general. The further we get outside of that zone, the more uncomfortable we get. So you guys are safe in Kansas City. Just don't come up here. We won't have to butt heads and compete. That'd be perfect. Or maybe we work together. So
home field advantage, right?
Yeah, exactly.
Absolutely.
Well, that's kind of a sports reference, Dan.
I know that was reaching for me, but I feel like it worked. I think I nailed it.
You did, actually. Yeah. So Parker, first question that I always have, like during this time, is what's changed for you guys during COVID from like an acquisitions, deal flow, underwriting perspective? Are you guys, I know you guys are hungry, you're hustlers, you're always out there, but what's changed? What's looking different?
So, I think first, so right when all this stuff started happening, right? I mentioned we're in multifamily, but we're also in other asset classes. And right when COVID happened, we were under contract on about $15 million of retail real estate. And as soon as kind of this stuff happened, and we had pretty long contract periods, we just kind of threw our hands up and said, we're going to wait to see where all of this falls, because I'm not going to buy $15 million worth of retail right now when people might not be shopping. So
for a while. Yeah.
Yeah, exactly. And so we pulled back on that and really kind of refocused us and gave us an opportunity to kind of double down on kind of strategy and vision. And focus down on what we wanted to do. So since then, we've been almost exclusively focused on, Kansas City multifamily. We've been almost exclusively focused on a few particular corridors where we have some sort of niche expertise. And so that's kind of been, for us, kind of first and foremost, there's an opportunity to kind of rehome the business plan, let's say. Operationally, obviously when you go into these various assets, you have to kind of think about, how does this affect everything? And so we have quite a bit of background in the affordable housing space. And that's really where we've kind of doubled down at times like now, which is interesting. I'd love to get into that later, because a lot of people are kind of making a flight to quality. And I think they think that's going to be the right decision. I disagree. So we've been kind of more focused on the affordable housing side. Obviously operationally, that's, we've had, folks come to us that, need some relief. We've had folks come to us that, need to move in because they couldn't afford the apartment that they were in before. Right. And so there's a little bit of both. I'll say across the board, our portfolio is performing about 100% of where it was before. So
does that include the retail component of what you own?
It does, but fortunately, the retail component that we own was all either relatively stabilized or was largely vacant, so it was kind of remains unchanged.
Mm-hmm. Gotcha. So, have you guys decided to, just out of curiosity, have you guys decided to maybe make a more permanent shift in your acquisitions going forward to focusing on mostly multifamily, or is that just kind of the interim focus because things are just kind of unknown right now? Are you guys going to go back to retail, do you think, or what do you think?
Yeah, no, we absolutely will go back to retail. I mean, frankly, we're opportunists at our core, right? We're value investors and we're opportunists. And so what we want to do is see there to be an opportunity. Frankly, we view multifamily as sort of it's kind of like the Goldilocks of the various assets, right? It's not too hot, not too cold. It is always just kind of right. And so we like to have that be a larger component of our portfolio. But we're still opportunistic about retail. We're currently acquiring some office properties.
Yeah. Well, they say when there's blood in the streets, that's when you go out and buy, right? And I think that would be right about now for retail, I'm sure.
Yeah, well, I think it's about to be. I think everybody's feeling it, but pricing hasn't gotten there. So that's what we're watching.
Gotcha. Okay, interesting. Yeah,
So you guys doing any mixed use stuff?
We do. We actually worked with one of our investment partners. We closed a mixed use property here after COVID. It was a really interesting asset. It's a combination of multifamily, office, and flex space. So it's a really cool property. We're looking at developing another 80 apartment units on top of that property. So it's a cool one that we're in the mix of right now.
I want to circle back real quick to the retail conversation. This is the multifamily roundtable, so we're going off the tracks here a little bit, but I think it is related because as these things move, they kind of move somewhat together. And you mentioned, the blood isn't quite in the streets yet. So I'm curious, what's the timeline to when we will start seeing blood in the street for retail specifically? And what are going to be those telltale signs that's going to lead to that, the price is kind of correcting and coming down a bit?
Yeah, I think more than anything, it's going to be occupancy trends, right? It's cash flow. Right now we've got a lot of these distressed retailers who are negotiating with landlords, and landlords are giving relief, but that relief is going to burn off, and those retailers still cannot afford to pay their rent. But bankruptcies, foreclosures, et cetera, all takes time. And so I think, frankly, our legal system is overloaded right now. And so until our legal system has the time to catch back up, we really don't have an opportunity to see the blood in the street, so to speak. So I think we're probably 6 months out before pricing is where we want to buy. If we see something sooner than that, we might jump. But frankly, I think we're probably 6 months out before retail pricing being kind of best.
Yeah, that aligns pretty closely with what we've been anticipating in the multifamily space. Not necessarily saying that we're going to see blood in the streets for multifamily per se, but there's going to be, I think that's when the reality of everything that's happened is going to be coming to light, whether it be, people in the single family home space getting foreclosed on because they've been in forbearance for the past 6 months, or, people who have been living off of the juiced up unemployment benefits that wearing off. That's going to be, early next year where we really see the full impact of this recession/depression that's been happening, but no one's really felt yet because we've been so supplemented so far.
Like Apple hitting $2 trillion in value, right? It's like, how is that possible in all of this? But
everyone's getting $600 a week. So that's an iPhone a month right there. So, it's going to be really interesting to see how that plays out. And I think it's good that you see the opportunities out there as opposed to, all the negatives. I think that's a really important part of being an investor and being, an entrepreneur is being able to go out and see where the opportunities are when things get crazy, as opposed to being focused on the negative and all the struggles that are out there.
Absolutely.
You have an interesting investment thesis right now, which is the affordable housing versus flight to quality. You hear a lot about the flight to quality conversation at the moment. It's very popular, but it's a little bit counterintuitive to say the affordable housing.
What does flight to quality mean right now? Actually, that's
a good point.
What is quality at this point? It's not Class A, right? What? What
You know,
is
I think for
quality?
some people it might be. I think for some people it's moving to Class A, or it's moving to high Class B that you can transition into low Class A maybe. But you know, people that would otherwise play in the C and B space are just elevating a bit. So you curious to hear Parker's thoughts on that and unpack your thesis for us.
Yeah. So, I mean, we play in two spaces, as far as that goes. There's sort of affordable and then there's workforce, right? And so there's a little bit of a difference between the two, but we have been able to find, workforce housing type assets as well that sort of cross-pollinate, let's say, with affordable. I mean, they're very similar and they track similar tendencies, et cetera. But when we think affordable, we often think, predominantly rent subsidized, right? Well, we're able to acquire, as an example right now, we're acquiring a 426 unit apartment portfolio, all workforce housing, right? It has maintained 99.85% collection since COVID, and NOI has gone up $100,000 since we've been under contract in May, right? So we've seen great improvements in that. Now, when you say, okay, what is the likelihood that is to go down when these employment benefits burn off? Well, one thing that we've done differently, I guess, now that we would have frankly never done before is we did an employment census in due diligence, right? So we went through and said, where are all these residents employed? And how is that kind of diversified by sector, right? Is it, retail, service, office administrative, et cetera, et cetera. It's not something we would have ever really thought of to do before. Not that we wouldn't have kind of reviewed some of that in a lease analysis, but it became, far more important to us right now.
And all that data is just right in the, docs you're getting for due diligence, right? So that's
in the leases,
yeah, okay. That's cool. I like that.
Yeah. It's just a matter of kind of filtering through it a little bit more and kind of more diligently or highlighting things that we would have, maybe not thought to highlight before.
Very cool.
So we're, in reviewing that, I think what we've seen is that, a lot of the workforce housing, I mean, these are proud working folks, right? These are people who are working, who are, working hard, who are going to find a way to work to pay the rent. Now, here's the thing, right? When you say, okay, well, everybody's going to get laid off, things are going to get, a little bit hairy, whatever else. Well, if you get laid off and you can't afford your $3,000, per month apartment, that's a whole lot different than getting laid off and not being able to afford a $600 a month apartment. I can say you can go knock my neighborhood and find, one-off jobs from all the houses in my neighborhood, and you can make your $600 a month rent, right? And so the ability to kind of go in there and I think be sort of innovative or entrepreneurial, as a lot of the folks who live in workforce housing are, they can go figure out ways to make money. And frankly, that threshold is so much lower for them to overcome to maintain their lifestyle.
So when you guys are talking about the affordable housing, you're talking about rent subsidized. So these are tenants that are getting some kind of assistance from a government program or a local assistance program. Do you guys have any concerns of what happens maybe in like the 6 to 12 month horizon if those programs can't keep subsidizing at the same rate?
So the properties that we have, so we have everything from, light tech properties, so low income housing tax credit properties, with substantial Section 8 vouchers, to workforce housing where there's actually not, this 426 unit portfolio, it's got 29 units that are subsidized, right? Of 426. Okay. So it's a small amount of sort of subsidized units.
Sure.
But I'd say we've loved it. A lot of people that have been concerned about what's been happening in their portfolios or what will happen in their portfolios since COVID, my rent's being paid by HUD for the most part on our properties. HUD's going to keep paying its rent, whether or not we have unemployment benefits or whatever else. This is an issue of whether or not there's a new budget to support the housing. This is a budget that's, 50 years in the making that has been supporting this housing.
Mm-hmm. And that provides an extra level of security, I think, as well, because I think if you look at, your break-even occupancy for a particular asset, and then you also look at how much of the rent HUD or any of these other programs are covering, it's probably around where your break-even is. So it's nice to have that kind of net. That worst case scenario, these guys can't afford to come up with their portion of the rent. This 80% subsidized portion is going to be covered, and that we know that's going to keep things going. That's going to keep the lights on. So it's I guess it takes away the binary aspect of having a typical tenant where it's they might pay or they might not. In your case, the might not is we don't get 20% of our rent as opposed to 100% if these guys run into a jam, which is pretty nice. And to my the point I made earlier about what is quality, I'd call that quality these days. Operational performance as opposed to whether it's glitzy and shiny is something that I would refer to as quality in times like this, personally.
So one of the main critiques that somebody would have, like other investors might have in that environment when they're talking about subsidized housing, is those tenants are more difficult to work with. For those that are just listening, I just did massive air quotes just to be very clear that that's not necessarily our belief here. What do you guys do the property management in-house? Is that something that you outsource? And then do you find that that statement is accurate or inaccurate when it comes to managing your portfolio?
So we do the property management in-house. And so we're actually in the process of merging with another property management company. So we have collectively about 600 units under management. We're going to blow that up to about 1,000 in the next 60 days and kind of keep scaling from there. But that's kind of what is in our portfolio that we're managing. We do the in-house property management, and I'll tell you that the idea of it being difficult, it's like so here's a comparison, right? It's like judging a fish on his ability to climb a tree, right? So if your entire operational culture is based around managing apartments that are filled with attorneys that make $250,000 a year, and then you have to pivot your mindset to go manage a population that is not that, I think it's going to be difficult for you. But if your entire operational culture is around providing affordable housing, understanding the marketplace around that, understanding how to reach out to the various agencies that support this population, et cetera, it's not any more difficult than just being good at anything else.
Yeah, I'd argue that the work, just as with any other tenant, is done on the front end. If you screen properly, theoretically, any tenant's going to be a breeze to work with. If you do the proper steps and make sure that this person fits the criteria, you should be good to go. I think it's sloppy screening on the front end that leads to difficulty with tenants for the most part.
Yeah, but there was something really insightful there, Parker, where you're talking about going into understand your customers' expectations and making sure that you're aligned with that. Like let's say, if you're serving dishes at a 5-star restaurant, those customers are going to have a very different expectation than the customers at Burger King, right? Doesn't mean that one's going to be more difficult than the other, because tenants at the 5-star can be very difficult. It's about how do you align your expectations with the customer that you're serving, and being cognizant that maybe with the subsidized housing or the Burger King client, they're not going to be maybe as picky, but they're maybe going to be requiring a little bit more consistent communication in terms of hey, these are our payment options, here's when this is due, in working with them as they navigate these tumultuous times. Whereas somebody in that class A world, they might just be more of a pain from a maintenance standpoint, saying every little thing they want perfect. So it can go either way. It's just a matter of your expectations and being properly aligned.
Well, I think as well, you as an operator have to understand, if you're, say for the folks who are maybe new into getting into multifamily investing, you have to think about, what mindset do you want to think about, right? I don't want to particularly have my head in the mindset where I have to think about what's the next new amenity that a high income earner is going to want, living in multifamily, how do I keep that person satisfied in this sort of constant, race to the top, but to wrap my head around, how do I provide good, clean, safe, well lit, well accessible, affordable housing where we treat people with dignity. That's something I can wrap my head around very easily.
Mm-hmm. So I have a question about LIHTC. So normally we're looking at multifamily properties on the value add side of things. And since LIHTC is constrained as far as how much you can raise rent, and I'm not that familiar with it, so that's why I'm asking this question. We look at investment over period, and let's say it's a 5-year hold period, and we're looking for certain expectations within those numbers to present to our investors. Is it the same philosophy with LIHTC, or is it more of a cash flow game?
So I guess there's kind of 3 pieces to that, actually. So part 1 is that LIHTC, as people conventionally think about this, it's development, right? It's not buying existing units, or you're buying existing units that might be under LIHTC and you're re-syndicating them. But LIHTC for the development side, or when you're actually going after and getting the credits, it's barely real estate. There's property management, right? But the whole thing is you're mostly creating an opportunity for tax arbitrage for some tax investor partner, right? It's different from the way that we're all trying to get yield on investment. And effectively, when you're developing LIHTC, you're saying, I'm going to get my fee, and I'm going to try to not lose money for 15 years, and then I'm going to try to get my fee again, or I'm going to sell, right? So that's kind of, the LIHTC business in summary. If if you look at kind of the next step there is you can, obviously acquire existing low-income housing tax credit units. And so one of the ways you do that is you buy something that's been done already. And then you re-up it at the end of 15 years. You can go re-syndicate tax credits, go resell those tax credits and manage that process. What we have been doing is buying low-income housing tax credit properties that are at the end of their compliance period. And so they are no longer, their LURA, Land Use Restriction Act agreement is up. And so we can go in there and push those rents. Now, we're particularly sensitive to those rent increases for that population, right? So we understand that, that can hurt. And so we know that we're going to do that kind of intelligently. As units become available, we can go push those. But frankly, we're not in the business of kicking out people with low incomes and trying to put somebody else in. It's just not what we do. But if you're talking about the kind of middle market stuff, it's different, right? Now, I'll say, if you look at the kind of trailing track record, since we're here talking about trends in multifamily, right? I've run this analysis on where the FMRs, the fair market rents are in Kansas City at the very least. And you have to do this for all of your own markets and kind of micro markets to see if it makes sense. But for us, those FMRs have gone up on average 4% per year. That's at least more than I model in my, my models of what our annual rent growth is going to be once you're stabilized, right? So for us, we're buying properties there where we think we can, go push those rents 4% per year, around 3 to 4% per year. And that's with those kind of housing vouchers paying the rent. And then as those other units become available and that LURA is burned off, we can push those rents even further as the market demands it.
So do you see the market, getting softer, or do you think that everybody's talking about the U recovery, the V recovery, and I don't know if that makes a whole lot of difference in necessarily what we do, but do you see that, and we talked earlier about, unemployment benefits running out and the telltale months are going to be September, October, November. What are you guys seeing because Kansas City seems to be pretty strong and you guys are just investing in Kansas City at this point, right?
Yep. That's right. I mean, for us, I've got a map pulled up here, kind of some data pulled up here that I'm looking at. Kansas City is sort of number 2 as far as kind of how it's been impacted, like number 2 in the country as far as, how well we're doing, which is, either behind Indianapolis or Phoenix, depending on which data set you're looking at.
What are they tracking there as far as like how well you're doing? Is it
occupancies, month over month rent growth, year over year rent growth, et cetera?
Okay. Are you guys seeing rent growth then? Or
we are. Yep. Across our portfolio, we have increased rents since COVID. We have had no issue implementing our rent growth plans on some of our properties, frankly, and our property management team does a great job. So kudos to them. I'm not directly involved in all this, but we've beaten our pro forma on every deal since COVID.
Now, is that rent growth on rents that were below market that you were working on getting up to market, or is this rent growth that in stuff that was already stabilized where it's still ticked up this year in 2020?
Yeah, it's a bit of both. Mostly it's kind of getting stuff up to market, right?
Yeah.
And frankly, that's what we look at. I'm not really looking at deals that are kind of at market rent and seeing how to either push it to premium or something like that. We're usually looking at stuff that is below market and just making sure we can implement that plan towards market.
Yeah, we've seen that on our end as well, as far as just getting rents above what we were shooting for so far. And I've been kind of attributing it to the just excessive cash that's in everyone's hands right now. It's going to be interesting to see what that's like over the next 6 months here. We're going into winter and all that extra cash is not getting sent out, or might be. But as far as I could tell, the updates I've seen have just been that the unemployment benefits are kind of getting tapered off, and reality is going to start setting in here. I'm going to be willing to bet that we're not going to see that growth going into the end of the year or in the first half of next year.
Yep, I would agree.
I think forecast.
I think what we're going to have in the multifamily marketplace is we're going to see yields compress for the next 12 months, and I think that's kind of for those of us who are owning property or already own property. So when you're talking about the rent growth as far as the yield goes,
yeah.
I think the demand for multifamily is as high as it ever has been.
What do you think is going to come down the pipeline as far as demand goes? Because I've got my own assumptions about what's coming down the pipeline based on where I think the single family market is going to be going over the next 12 months here. What are you guys anticipating over like the next 12 to 24 months as far as demand for multi?
So I think demand's going to increase. I mean, I think people are pushing money off of, let's call it Wall Street to Main Street, and want to get into assets that are performing a little bit better today. We're kind of projecting out. I'll tell you, we're projecting out cap rates that are higher 12 months from now than we are that are kind of current, and that's sort of more just kind of our own level of conservatism as we're getting into things. We want to give ourselves a buffer. And
was it like that 4 or 5 months ago? Is that consistent with what you've always been doing, having those cap rates increasing?
Yeah, I mean, this is kind of our underwriting standard.
Yeah.
We'd rather kind of be pleasantly surprised about a bigger benefit than anything else. But I'll tell you right now, I mean, I was reading an article today about another San Diego-based fund that is targeted Kansas City, particularly for office, retail, and industrial. But I think we're going to see that continue to happen. And I think I was looking through just all this data and looking through the trends that have been happening in COVID, right? I mean, I think that you've got this. Like you had mentioned before, Dan, as far as kind of flight to quality, right? I mean, everybody's saying, hey, these New York, San Jose, San Diego, LA assets that are super low yield and are, my rents are going down, et cetera, et cetera. I think those folks are going to say, hey, Kansas City, hey, Minneapolis, you guys look pretty attractive to us right now.
Yeah, I'd agree 100%. Yeah, I think there's going to be a large increase in demand as some of those single family forbearance periods come to an end here, where people who are living in their primary residence who did lose their job, who have been receiving benefits, unemployment benefits, that's running up and their forbearance is running up. I think there's going to be some foreclosures coming in the near term in the next 6 months or so in the single family home space that's going to push more demand into the rental space and into apartments. So that's kind of what I'm forecasting over the next, 12 months here. I hope it doesn't happen. I don't want that to happen to people because we're doing just fine without that negative occurrence happening. But we did see that in 08 and 09 in the multifamily space. There was a big influx of homeowners turning into renters just because of, you get foreclosed on, you're not going to go buy another house right away. Right. So unfortunately, I think that is coming down the pipeline.
I think Parker touched on something interesting there, which is that there's two ways of really looking at the demand situation. One is from a demand from tenants and like, are people going to be needing multifamily, which absolutely they're going to. And then the other side of that is actually from the investment side. Is there going to be demand? Are there going to be people wanting to put their money to work? And Dan, we've seen a tremendous amount of interest from individuals wanting to get out of Wall Street and go to Main Street, as you've pointed out there. And so I think it's going to be interesting because in a 12-month horizon, let's say, there's going to be more demand, we think. Multifamily is always like in high demand across the board, but then we're also going to still have a high demand from investors. So it's interesting, like, are the prices really going to come down? Is it going to fundamentally shift if there's, these investors from like the East and West Coast who are used to low yield, now they're moving into the Midwest and they're saying, hey, we'll pay a little bit more for this. So, what's that really ultimately going to do for the cap rate situation in say Kansas City or Minneapolis? And that's something I'm curious about. Dan kind of was asking, hey, how's were you guys always projecting out a rising cap rate scenario in your underwriting? Are you guys being more conservative and assuming it's going to rise, let's say, more than usual? Or what other adjustments are you making in your underwriting right now? Or are you just not, because it's kind of a murky crystal ball to look into?
Well, so here's part of it, right? We're assuming more than anything. I think, on the cap rate side, we just project out that so we have some spread, right? I mean, we want to make sure that we have some spread on the back end and that we feel comfortable. But where we're probably getting the most conservative in our model is, whether it be, so across our portfolio, if you look at, we're doing well across our portfolio, but even in our conversations with folks that we're talking to, or, I was reviewing the National Apartment Association's kind of July survey. I don't know if you guys have been reading those surveys from their COVID surveys, but I think really valuable information. I mean, across the board, we've seen that. So we've done this and we've seen this from other folks, right? So a freeze on capital improvement projects. Okay. Mm-hmm. So you've seen, we did this, we had some units we were building out. We had some units that we were going to refresh. We put a pause on that for the longest time, but we're starting to get back into doing those capital improvement projects now. We're all seeing, slight increase in vacancy or delinquency. It affects, everybody a little bit differently, but we're all seeing a little bit of that. Definitely lower rent growth, and to some extent, some increased operating expenses and kind of extra cleaning, maybe some extra administrative support to deal with some of this, et cetera. Right. So we're seeing, I think, some pressure on we're seeing some pressure on kind of the income and expense item. We're not pushing as many capital events. I think a lot of that kind of paused, right? So a lot of that construction that was going on kind of paused, which would normally force appreciation, right? More so forces apartments up, forces comps up, which despite the fact that we all value, multifamily real estate on the income, those comps still mean something to appraisers. So I think it's all going to continue to push. It's sort of compressing where we would have seen those pushes. And our own underwriting, where we're the most conservative, is that, when we would have thought on a property, we could go in, spend the CapEx and push those rents over, let's call it an 18-month period. So a little bit of transition time and 12 months to stabilize those leases. We're now saying, hey, what if we budget out 12 to 24 or 12 to 24 months more than that? So we might be 36 months on kind of a transition to market leases. And so that's how we're underwriting things today, giving ourselves way more time to execute the strategy. And then if we can still back into a return that is justifiable, we're getting after those deals.
So on your underwriting, as far as, funding structure, do you, because if you're pushing that out 36 months, a lot of times with agency debt, you're constrained on the amount of time you can delay doing renovations. Are you then in turn raising all your CapEx dollars instead of trying to roll those into the loan?
Yep, that's correct. And that's where maybe we're a bit more conservative too than before, or returns might be a little bit more compressed than before, as we're coming in with a whole lot more equity cash on an LTC basis than we would have prior. But it's something that we feel comfortable with. Freddie and Fannie are, they're getting a lot more aggressive now than they were 5 months ago. I don't know if you all were doing any deals right then, but they were not competitive. Our local banks and kind of, bridge money was more competitive 4 or 5 months ago. But they kind of got back in line. Their reserve, that they have for principal and interest reserves has come down. So, we feel really good about that. And from a conservatism standpoint, as far as kind of, what our LTVs or LTCs are, I wouldn't say that we're going in with any lower LTV, but typically lower LTC, because there might be some kind of add-on construction loan or bridge loan or some piece that we have kind of a drawable facility. But as far as what's kind of getting funded at close, it's pretty comparable. And especially since that perm debt has come down in pricing, we feel a lot more justified in it. People say more debt is more risky, right? I mean, it's kind of standard. Everybody thinks, more debt in your LTV, more debt in your stack, it's more risky, right? But if you've got 65% debt and you're paying 8% interest, or you have 80% debt and you're paying 3% interest, I'll take 80%, 3% interest all day. I think that's way less risky. And so I think that that's kind of another calculus that, people don't talk about that often.
Yeah, that's a really subtle little nuance that definitely people aren't really considering very much. In recent months, we're starting to see agency coming back on, and like there's still some requirements, some reserve requirements here that make it a little bit tricky. But I'm curious, as you guys are moving forward, you're dealing with your investors, because you do syndicate, and so you have some passives that you work with. Are you starting to readjust their return expectations and saying, hey, for the foreseeable future, we're going to actually make a safer play here and not go after these like really, really juicy returns? Let's dial back our expectations. Or is it kind of all full steam ahead, same as usual? We're hitting our actually, I don't know what you guys is like your targeted return metrics are, but are you guys still on course for that?
Yeah. So standardly, I mean, for most of our deals, we're kind of targeting, it's called a 17 to 20% IRR, 2.0 equity multiple in a 5-year span. That's kind of standard investor level return that we look for. But that's for it's called a light value add type property, which is most of what we do. For heavier value add, we're going to want to push it from there. We have, some projects that we're doing with much heavier value add or more almost development level risk that, we're looking at high 20s, low 30s in terms of returns to justify those. We're still doing both, right? So I think when it comes to any of those, we're saying, hey, anticipate that we might have longer at the beginning. What we are doing is saying, hey, we're going to skip a quarter on distribution payments as far as anything over and above preferred returns. Or we might say, so typically our standard was our first full quarter, we're going to pay the preferred return distributions, right? And we're not saying it's going to be the second. We're going to hang on to a little bit more cash. If we're all in good shape at the end of this year, we're going to distribute that at the back end. We're going to hang on to a little more cash. We have a little bit more buffer to endure whatever storms might come our way. And I think that has helped just kind of reset expectations for some folks, or people are getting comfortable having a little longer delay in that. But we're still looking for return profiles that are, the same as we were before.
It's interesting that you say that you do quarterly returns, because I think that's where most of us sit. But Dan Hanford touts that he does monthly distributions, and I wonder if that's been refocused since this COVID situation.
Well, and I think my biggest issue, I guess, with doing monthly distributions is that cash flows in multifamily real estate are not smooth, right? It's do not have a consistent income stream every month, and so those quarterly distributions allow you to smooth out those cash flows and not have to say dip into reserves to pay distributions or something, right? Because those quarterly, the 3 months allow you to smooth that out. We're looking at some T12s, and the past 3 months on one property that we were under contract on, had an income of 50,000 one month, 80,000 the next month, 65,000, right? But smoothing out those cash flows is helpful. And when you get to understand why, there were some leases stacked on top of each other that came up at the same time, and so that affects cash flows, et cetera. But we just think the quarterly distributions are better, and frankly allow us for a much more predictable kind of cash flow to make those distributions.
I'm curious, Rodney, do you guys do the quarterly as well? Because you hear the conversation from some sides of the fence saying the monthly is the way to go, and then some people saying the quarterly is the way to go. For me, it's always been like the monthly is like great in theory, but in application, I don't think it really makes all that much of a difference. Like I'm not quarterly. I'm not living paycheck to paycheck, month to month. Cash flow isn't the necessity. And I'm guessing for most passive investors, they might want to see the monthly return because it's nice, but they're not relying on it per se. So the quarterly is not going to functionally change much.
We do the quarterly, and we have clauses in there that if we need to hold back on the distribution, we can, because like the property we just acquired in Montgomery, Alabama, that one we had to readjust distributions on a little bit because of coming into COVID. We weren't really sure where cash flow was going to land up. We've actually been doing just fine. Collections have been great. Our renovated units, when they're coming online, they're getting our expected rent bumps that we had planned in underwriting. So that's been going really well. And but I think we're still kind of taking a conservative approach because we don't know what, just like we were talking about earlier, we think that we're really going to see the results of this COVID situation here in the next couple of months because of the dry up of the unemployment. And even though President Trump put in this tax holiday, it's yet to remain to be seen how that's going to play out.
Mm-hmm. So Parker, transitioning a bit in the last month or two, well, let's say in the last month and a half, we've seen a sharp uptick in deal flow. When COVID first happened, we had some deals in the pipeline. We pumped the brakes really hard. Similar situation that sounds like you guys did. And then by the beginning of July, we started seeing a lot of deals coming through the pipeline. Whereas for the months before that, it was just crickets. Are you guys seeing similar volume now? Did you have a drying out period? And what are you seeing from the sellers in your particular market in terms of like, what are their expectations? Are they driving still a hard bargain, or are they starting to soften and trying to just exit out of these properties?
I really think it's a case by case basis for the sellers. But I mean, as far as the deal flow goes, we have probably maintained very similar deal flow. I think our multifamily deal flow has probably picked up, but I think that has more to do with our kind of mindset shift and focus, right? And so you start to see more when you're more focused on it. And while we were kind of doing the retail and office and some other stuff, to have, a pure focus on kind of multifamily recently, I think we've seen more. That said, I have, found, a few folks that have come to us that, their reason to sell is just, we live in Kansas City, right? So there's, Lake of the Ozarks is nearby, big lake, more shoreline than California. And so guys will say, hey.
And a fantastic TV show.
Right. But, folks will say, hey, I just want to go drink beer on my boat. So I don't want to deal with this management anymore. So a lot of the mom and pa's are kind of just saying, this is one more thing, one more, once in a lifetime events that's happened in my lifetime that I kind of just want to throw my hands up, sell my property and go drink, on my boat. So we've had a few of those guys pop up. I will say though, that part of the reason we've probably seen some additional deal flow, and I imagine you all for similar reasons. I mean, the portfolio we're under contract on right now, it was on the market in January, came off the market, when COVID happened, right? It was on the market at 23.5 million. We liked the deal, didn't like the price. And so we kind of sat around. They took it off the market. We called them and said, hey, what's going on here? And they said, well, with COVID, all of our New York and California buyers can't fly into town and can't offer on the property. It's like, well, we don't have to fly in. I can drive over. It's 15 minutes. Y'all see you at the property. And so we could go tour, we could go do our due diligence, we could go do that. And because that California and New York money couldn't fly into, Kansas City and drive the price up, we were able to get that for 21.2, right? So over $2 million price discount that frankly, if that California and New York money had come in, there's no way we would have gotten that price. And so this guy, was kind of at the end of a fund, they were selling off, et cetera. And so I think we've had more of those folks come to us that have said, hey, sometimes would have taken this to California, but those guys couldn't come. So you guys want to take an offer on it. And so I think it's kind of decreased the total number of people in the market, which has kind of increased our view of deals.
Well, that is good. I mean, I wish that I could say that because most of the deals that I've seen come across my desk have been what I would call pre-COVID pricing, and the expectations are still high because the NOI is still there. Right. And so, I mean, I get it why they're holding out, but at the same time, with the reserve requirements and things, there's no way that you can make that really work the same way it did before. And yet, like I was looking at a deal in Jackson, Mississippi, and the thing went for over asking price. And I just don't see how they can pay that, but it does happen. And maybe there's going to be some blood in the streets like you guys were talking about earlier here in a couple of months, which would be great.
Yeah, I don't really get the sense that there's going to be a lot of multifamily blood. I think if
interest rates grow up, there will be blood in the streets, but that's not going to happen.
Not for a while.
No,
they're too low.
If interest rates go up, there's going to be some carnage. But
yep. Yeah, it's an interesting situation. I think there for us up in our markets, we're still seeing a little bit of an impasse between seller expectations and what our new underwriting standards are, as we're trying to skew a little bit more towards conservative in an environment where there's still just so many unknowns. So
yeah, I mean, it makes sense. I mean, the sellers, they're looking at their NOI today and it's like, okay, here it is.
It's
here are the cap rates. And we're thinking, okay, what's next? What are the next 6 months going to look like? That's where the adjustment needs to be made, and the sellers could care less what's going to happen in 6 months. It's all about what's my T12 look like? What's this month's look like? And today looks great. It's just tomorrow. Is that going to be good or is that going to suck? That's where the risk is now. So
one thing I have found is that with the reserves the way they are, and sellers, some of the sellers understand making that work and keeping your returns to where investor expectations are. They have been willing to put up the reserves. If you go like with a Freddie, where it's, you can get 90 days, they'll put the reserves up out of sale proceeds. And then as long as you maintain a minimum DSCR, then Freddie will cut that loose. Of course, the seller has to be comfortable with you doing that. And, that's where a track record comes in, but that is an option for people to look at.
Yeah, I think that's innovative. I mean, we had tried some things similar to that, or putting it away and then kind of saying, hey, this has to stay here, and then we want to see occupancy stay above certain levels, and then we'll release it to you. Because that was our biggest concern, kind of March, April, May, was that we're going to get into this at 97% occupied or something, and it's going to drop to 75, and then we're hosed. And so we were kind of trying to negotiate as part of our purchase prices that some amount of the sales proceeds would be set aside. And then they would kind of get released once, all of that was maintained. No one really bought on that at that time. I don't know if that would be more of a strategy today. But we kind of did the same thing. So we had those conversations. And I'd say that, I think our hit rate has increased a little bit more than it had before. But don't get me wrong. I mean, our hit rate's still probably 95% fail, right? I mean, we're probably.
What do you mean your hit rate? You mean like offers made versus deals accepted?
Yep. Yeah.
Okay. Gotcha.
I mean, I think we're probably, there are 20 times more deals than, that are telling us no than are telling us yes.
Yeah. It's interesting right now. There's so many ways that you can be creative and innovative with these deals to try and get them to work. I think what we're finding, Dan and I in particular, is that the sellers really don't need to get creative at this moment. They don't need to be innovative, because where there's one of us willing to make this solid deal, there's 5 others behind us willing to make an even better deal. And so, like, we're still kind of in this position where, the broker's saying, hey, like, if you want to get this deal done, you're going to have to go a little bit above and beyond to make this even more interesting. It's like, well, we're not going to do that. So I guess we're just going to miss this one for now.
I think that's just a product of liquidity. I mean, there's just so much capital out there to be put to work. You got to come.
It's demand.
Yeah. It's pretty basic supply and demand. So unfortunately, no blood in the streets yet.
Right.
No,
that's the tough part. When there is blood in the streets, there's no capital.
That's a check. Yeah.
Yes.
So what are you guys doing to prepare for that eventuality, if that was something to occur?
So proactively, we are in the process of setting up and launching a new fund. So we do principally syndicate, but we are going to syndicate into a fund. There's one target area. It's 13 neighborhoods in Kansas City that we like a lot, that we do a lot of business in, and frankly want to keep doing business in. And we have really great relationships there with both property owners, neighborhood associations, et cetera. And so we're going to go proactively raise that fund ahead of time. We're going to keep buying. But then as, hopefully there might be some blood in the streets with some folks, and that'll just give us an opportunity to go buy with cash in hand.
Mm-hmm. Yeah, we're executing the exact same strategy at the moment. I think a lot of people are. They see the writing on the wall that the key is going to be to have dry powder in wherever you keep dry powder when the time comes to start firing whatever it is that you put the dry powder into.
It's one of the conundrums of investing is typically the best time to put capital to work is not the best time for raising capital. Usually raising capital is best in times when there's nowhere to put the damn stuff. So it's that issue where it's like, okay, it's great to raise capital now, but in like 12 months is when it's going to be shopping season, right? So I think that's where the fund structure makes a lot of sense. And that's why we're thinking the exact same thing. We're getting ready for 6 to 12 months from now when there's things are on sale. Hopefully, fingers crossed.
When can we look forward to seeing you guys launch your fund?
It'll be this fall, so you should be looking for it. We're shooting for kind of a mid-October launch.
Sweet. Yeah, we're riding parallel tracks here.
Do you mind me asking what the size is that you're going to raise, or do you have that determined yet?
So we're going to go after, for this particular area, we're going to do a $10 million fund with the ability to extend to 25. Okay. I'm going to go buy kind of 40 to 80 million of real estate in this corridor.
How long was your raise for on that? How long are you raising?
We're going to do a 24-month raise. We hope we can get it done a lot sooner than that, obviously. But 24-month raise period and kind of 3-year deployment period and then 5-year hold period. So we're going to do a little bit longer term fund, than sort of the 5 to 7. We're going to do more like a 10-year total strategy.
Yeah, and this is a multi-family focused fund, right?
Yeah, multifamily focused. Although, one thing that we're looking at doing is we'll do a little bit of commercial in this corridor, very, very small amount. I mean, it might be 5-10% of the whole fund. And that's really just to supplement the multifamily stuff because, if there's this area, this whole corridor is kind of a turnaround corridor. And so when we need to go, I'm not going to put a bunch of new nice stuff all around and have some rundown office or retail building. I'll deal with that and fix it up and clean it up and get a tenant in and it, improves all of my multifamily. And I kind of view it as an amenity. But one thing we're also looking at doing as well is taking a small portion of that fund and using it as either an ability to make forgivable loans in this corridor to existing property owners so that they can make improvements to their houses or down payment supplemental assistance for folks to go in there because we want to make sure that we're kind of improving values that the community is benefiting from that as well.
That's a really cool angle to have to it as well. It's not all about just deploying capital to make money. It's actually about improving the actual neighborhood, right?
Right.
Pretty cool.
Yeah, and I think that's the whole thing, right? If we do this the right way, we're going to make a whole lot of money, and the neighborhood's going to be a whole lot better, and that's just a win-win.
Win-win-win.
Yeah, that's a really interesting strategy because often we talk about the fact that, you know, you need to pick your neighborhood with great care because you can improve your building but you can't do much to improve the neighborhood. So your goal is to pick, you know, the worst building on the block and bring it up to par with the rest. Because if you have the best building on the street, that's only going to go so far. But you guys' strategy is, hey, what can we do actually to help improve the rest of the buildings too? Which, you know, the rising tide lifts all boats.
Right. And then I think that, you know, even above that, it's the idea of we're picking an area, we're picking a size of fund where we can go deploy and we have good relationships, right? Where there will be a tangible difference in that entire neighborhood by this one fund going in and deploying that much capital, right? So it's an area that's small enough to have that big of a yield on the entire neighborhood, push pricing, et cetera, whatever else. But we also think, yeah, I mean, if we can make some forgivable loans. If there's a single family home down the street that's, you know, in crummy shape, and I can go down there and say, hey, I'll give you a forgivable loan of $5,000 to paint your house. That's only good for me.
So are you looking to go into opportunity zones on with that, or are you going to not approach that?
This entire corridor is in an opportunity zone. We frankly won't structure ours as an opportunity zone. We are doing 2 opportunity zone deals in that corridor right now, just because frankly, that was a function of capital demand, right? So our investors said, hey, we need an OZ deal. I said, well, this one we didn't intend to be an OZ deal, but we'll set it up that way for you. We don't want to deal with the complexity of it. I don't want to deal with the restrictions, et cetera. But if we have investors who come in because of our kind of longer term deployment period or longer term hold period, we will kind of do sidecars for OZ investors and say, hey, come into this deal with us. We'll sidecar it off. We'll structure you your own OZ fund, and you can come in on side of our fund.
What is your standard hold period on your normal structures?
It depends on the strategy, but it's either a 5 or a 10-year hold. Really, for much heavier value add, we'll kind of look at a 5-year. We've got one deal right now that's really sort of a 3-year strategy, and that's because it's 30% occupied. I mean, we're going in and just total, you know, gut rehab in the place, and so we want to just kind of get in and get our money out. But that also might be a refi deal.
Yeah, I was gonna say, so are you gonna exit that or refi it? It sounds sometimes those could be a real great refi opportunity.
Yep. Yeah. And that might be the way that we go. I mean, that deal we have one investor on. And so, you know, it's kind of, you know, with that sort of one investor on that, you know, sort of a matter of kind of going to him and saying, hey, you know, we'll take you out or you take us out, or, you know, there's sort of a negotiated agreement on the back end there.
Yeah. Those are always kind of nice deals where, it's small enough you can have a little conversation and say, hey, what's good in best alignment with your needs and wants right now? Do you want to get out of this? Maybe we can take it from your hands. So that's pretty cool.
Yep.
So do you think that investor expectations on the length of hold is something that they come to grow into as they deal with certain operators? Because there was, you know, pre-COVID, we were getting to the point where we really needed to have a longer hold period to get the numbers where we were wanting them. And a lot of the capital raisers that we typically saw on deals were coming back saying that those hold periods exceed our investors, you know, anticipated hold period. And so I'm just curious, you know, and I ask other people the same question is, what are your investor expectations? And are those expectations really tailored and set by you?
Yeah. I mean, I think, you know, the PE funds of old, right? We typically take 24 months to raise and deploy, 36 months to kind of harvest, or, you know, 60 months to harvest. And so I think that kind of set, you know, the private equity standard kind of across the board for real estate as well. But I mean, I think, you know, I mean, I think we come up all the time on a lot of our investors have they view a lot of the, you know, the literature, they view a lot of, you know, podcasts and conversations. They, you know, have invested in a number of other syndicators. And so that does all kind of create kind of an anchoring effect, right? For where they say, well, you know, these guys are doing this in 3 to 5 years, so why aren't you doing it in 3 to 5 years? Well, for us, it comes down more to the strategy. We don't want to have so little time to execute a business strategy. We want some flexibility, but we also don't, you know, I don't want to wait 10 years to get paid on my promote. So there's a little bit of kind of nuance there. But for the most part, our investors they like 5 years. I would say probably more than anything, most of our investors want a 5-year hold. Some of our investors like 10 years because they just want to, you know, write a check and not think about it for a very long time. But I'd say 5, 7, 10, that's kind of the sweet spot for us.
Yeah, that's kind of where we're landing up is 5 to 7. 6 seems to work more often than anything. And you would think that 1 year wouldn't be that big a deal, but it tends to be on some of those 5-year guys that's what they want is 5 years. But I, if you look far enough, you're going to find people that 6 years, they're fine with that as long as the returns are up there where they need them to be. So.
Mm-hmm. Well, hey, Parker, we're getting to the top of the hour here, and I want to be respectful of your time. And I want to show great appreciation for you because you've just dropped a lot of knowledge on us, and you guys are doing such cool things. I've chatted a lot with Logan in the past, and I'm really optimistic in the things that you guys are creating down there. So I'm looking forward to seeing this fund launch and you guys just continue to grow and expand. I do want to ask a parting question, which is, what are the risks and opportunities right now that people aren't seeing or talking about?
It's a great question. In multifamily alone, well, in any investment, right? I think that even though we've had kind of an event happen here, that there's this stasis, I think, is always the enemy, right? And so there's this assumption that, things have been, and so they will be. And that is, I don't think, the right way to think about it. When cataclysmic events happen that, trigger something that is totally unforeseen, you have to be able to, kind of think differently and think about all of that changing out from under you. And we don't do good thinking about change, right? So it's very difficult for us to think about. So I think that people are, we underestimate how permanent something can be, and we also underestimate how temporary something can be. And so I think that there's sort of a cognitive dissonance between those two things and how people are viewing the marketplace right now. So I'd say, our biggest risk is our own mindset, probably, and making sure that we're in line with where things are today compared to where they were before. Opportunities wise, though, I think that that's the same thing, right? So I think that while we're all kind of doubling down, we're buckling up, we're, starting launching funds so that we can go get dry powder on hand. I think that that's huge. But I also think that, despite, exponential amount of literature out there on multifamily, and we all like multifamily best, I think there's other asset classes that people should be looking at as well.
I love it. That's a great answer. I think there's really not much to add there because Dan and I have had that conversation before. When things change, it's so easy to think that it's going to go back to the way that it was without realizing we're still playing the same game, but the landscape's changed. It's like if, before we were playing football on your nice traditional pitch, and now we're playing on a rocky terrain. It's like, it's the same game, but the way that you're going to play is very differently. So I love that advice. So before we let you go, before we let you out of here, where can people get a hold of you if they're interested in learning more about what you guys are doing at FTW and learning more about Kansas City investing? Yeah, absolutely. So our website's a great place to find us, www.ftwinvestmentsllc.com. Logan Freeman is far more active than I am on LinkedIn, but LinkedIn's a great place to find us. It's hard to be more active than that guy. Yeah, I don't know. I mean, Yona Weiss might be more active. That's true. So. I love it. Hey, your guys' website's beautiful, by the way. So just wanted to let you know. You guys just recently launched that like a month or so back, and it looks great. So, all right, guys, that's going to do it for us here at the Weekly Multifamily Roundtable. The train is entering the station. It's slowing down. We're letting you off. Go home. It's like a guided meditation. But you can't stay here. Yeah, I'm trying to do like the ASMR now. Like, yeah, just release the tension. Now, take everything that Parker's mentioned here tonight about shifting your perspective and your mindset. Take that to heart and evaluate how you can implement that into your day-to-day life and your investment practices. And we will catch you. When are we doing this again, guys? On the next side? Next week. Same time, same place. All right, guys. Absolutely. See you guys.